Have you heard about this? This shock some homeowners are apparently facing in 2025.
I have, yeah.
We're talking mortgage payments just leaping. Hundreds, sometimes thousands of dollars a month, like overnight.
It's definitely highlighting a, let's say, less visible side of owning a home, something that can cause real financial pain very fast.
Exactly. And for this deep dive, we looked at a YouTube video. It's from the Homestead Journey channel called Americans Are Giving Up from Insane Mortgage Payments in 2025.
Okay.
And our goal here isn't just to, look at the big numbers and gasp. We want to really get into why this is happening based on the stories shared in that video.
Right. What are the actual factors causing these huge jumps? Because it's not usually the interest rate itself changing, right? Not on a fixed mortgage.
No, exactly. That's the kicker. You think you're set with a fixed rate, but these other costs, they're managed through escrow, and that's where the trouble seems to be starting.
Precisely.
Yeah.
Escrow accounts for taxes, for insurance. Those can definitely fluctuate.
So the video gives some general examples first, like payments going from $1,800 to maybe $2,800, or $2,500 up to $3,500, significant jumps.
Still substantial hits to a budget.
Oh, yeah. But then it digs into this one specific story, and this one really makes you stop.
Yeah.
This homeowner's payment went from $3,832 to roughly $7,200 a month.
Wow. Okay, nearly double.
Yeah.
That's potentially devastating for a family budget.
Right. So what happened? How does that even happen?
Yeah, what were the drivers there?
Well, the homeowner explains it. It's basically a pileup of escrow issues. First, there was a shortage carried over from the year before.
Okay, so they were already behind.
Yeah, and then that got combined with some major underestimations for the current year. The biggest one, county taxes. They were projected, get this, at $539.
Just $539 for the whole year.
Yeah, that was the projection. But the actual bill came in at $4,627.
Ouch. That's a huge difference. That sounds like maybe a new construction issue where they estimate based on land value first.
Exactly what they said. It was a new build, and the initial tax projection was way, way off once the actual house value was assessed.
Okay, that makes sense, but it's a massive shock if you're not prepared for it.
Totally. And it wasn't just the taxes. Their hazard insurance also jumped up by $11,131.
Mm-hmm. Insurance costs are rising almost everywhere.
And there was an MUD tax increase, that's municipal utility district, right, for local infrastructure.
Yeah, those are common in some areas, especially newer developments.
That went up $598, and then school taxes, another big hit, $5,671.71.
Goodness. So taxes, insurance, local assessments, all increasing significantly at the same time.
Yep. Add it all up, and they were facing an escrow shortage of $23,311.
$23,000.
Yeah.
Just to catch up on the escrow.
Exactly. Now, the mortgage company, they did offer a way to spread that shortage out over time.
Okay, some kind of payment plan for the shortage.
Right, which brought the new monthly payment down from that terrifying $7,200 to $5,663.
Still, that's almost $2,000 more per month than they started with.
Way more. And the homeowner said, look, even $5,663 is just, it's not sustainable for them. So they're selling the house now.
Wow. A really tough situation.
Yeah. And they did say, they take responsibility, but they also felt like maybe the realtor, maybe the mortgage company, maybe someone should have given them a clearer heads up, especially about how much taxes could jump on a new build.
That's a fair point. It raises questions about, how well are these variable costs explained during the buying process? Are buyers really made aware of how much things like taxes and insurance can change?
Seems like maybe not always or not clearly enough. Okay, so that first story, that really shows the impact of underestimated costs, right? Taxes, insurance rising.
Definitely.
But the next story in the video, this one adds another layer. It suggests maybe some issues with the mortgage company's calculations or communication.
Oh. What happened in this case?
This homeowner, their payment suddenly doubled, went from $1,100 a month to $2,400.
Another huge jump. What was the reason given this time?
Same basic explanation from the mortgage company. Not enough in escrow. Plus, they cited a $6,000 increase in property taxes.
Okay, similar factors again.
But here's the twist. This homeowner, they decided to check the numbers themselves. They looked into it.
Good for them. And what did they find?
Well, the mortgage company claimed this $6,000 property tax hike, right? But the homeowner found their homeowner's insurance had only got up by $711.
Wait, just the insurance. They checked the taxes, too.
The video focuses on them finding the insurance discrepancy. They specifically remembered the $711 because they said it rhymed with 7-Eleven. That detail stuck with them. But the implication is the $6,000 figure from the lender seemed off.
Hmm. Okay. So a big disconnect between the lender's explanation and what the homeowner could verify, at least for the insurance part. That definitely raises questions about that escrow analysis.
It really does, but wait, it gets even weirder.
Okay.
Just the month before this massive payment increase notice, the same homeowner got a check in the mail from the mortgage company for $2,900.
A check. Wow.
The letter said it was an excess in their escrow account. They had too much money, supposedly.
Hold on. 1 month, they have a $2,900 surplus, and the next month, their payment doubles because of a massive shortage and a supposed $6K tax hike.
Makes no sense, right? You can imagine the frustration.
I absolutely can.
Yeah.
That would completely undermine any trust you have in what the mortgage company is telling you. 1 month surplus, next month crisis.
Exactly. And the homeowner felt totally powerless. The company basically said, well, you either pay this huge lump sum up front. I think they jokingly threw out like $9,000-$10,000 just to make a point.
Right, some impossibly large number.
Or you pay an extra $1,300 every month from now on. It was like, oops, our bad, but now it's your problem.
Yeah, that feels incredibly unfair and confusing for the homeowner.
Yeah.
Just pay up. No real recourse offered.
So these two stories, I mean, they're individual people, but they really seem to point to some bigger vulnerabilities, don't they?
They absolutely do.
Mhm.
It's this unpredictability of property taxes and insurance premiums. Even if your loan's interest rate is fixed, these escrow costs can just explode, and that creates real instability.
And the video creator points this out too, says it's not just isolated cases. These rising taxes and insurance costs seem to be a growing trend.
That aligns with what we're seeing broadly. Property taxes are increasing in many places due to rising home values and local budget needs. And insurance, well, that's a whole other story.
Yeah, the video mentions states hit by natural disaster seeing really sharp insurance hikes, which, makes sense from the insurer's risk perspective, I guess.
It does. Climate change, more frequent and severe weather events.
Sure.
Insurers are definitely reevaluating risk. Plus, inflation affects rebuilding costs, which also pushes premiums up.
Right, and this leads to something else the video brought up, which sounds pretty alarming. Insurance companies actually pulling out of some areas, like not writing new policies or even dropping existing customers in places they see as too high risk.
Yes, that is happening. We're seeing it in states like California, Florida, Louisiana, areas prone to wildfires, hurricanes, floods. Insurers are limiting their exposure.
So what happens then? If you own a home, your mortgage requires you to have insurance, right? What if you just can't get it?
That's a huge problem. It puts homeowners in a terrible bind. Technically, you could be violating your mortgage terms. The lender might then force place insurance on your behalf.
Force place, what's that?
It's coverage the lender buys to protect their interest, the property itself. But it's almost always way more expensive than standard insurance, and it often offers much less protection for the homeowner's actual belongings or liability.
So more expensive, worse coverage. Great.
Exactly. And in the worst case scenario, if you can't maintain required insurance, it could even lead to foreclosure proceedings. It's a really precarious spot to be in.
Man, that's a scary domino effect. Okay, so given all this uncertainty, the video creator offers some advice for people, especially potential home buyers.
Sensible given the context.
First point, and it seems obvious, but maybe more important than ever, don't stretch yourself too thin financially. Their words were, don't bite off more than you can chew.
Absolutely fundamental advice right now. Buyers really need to look past just the principal and interest. You have to factor in potential increases in taxes and insurance. Build in a buffer. Assume those costs will go up?
Yeah, don't just qualify for the max loan and assume you're fine.
Precisely. That maximum approval amount doesn't account for these potential shocks down the line.
They also warned about zero-down mortgage options, kind of framed them as a potential trap.
Okay. What was the reasoning there?
Basically, if you have zero equity built up because you put nothing down, you have much less flexibility. If these big payment jumps happen, or if property values dip, you can't easily sell without taking a loss, and you don't have that equity cushion to absorb the higher payments.
That's a very valid concern. Zero-down loans make homeownership seem accessible, which is good in theory, but they leave the homeowner much more vulnerable financially, especially in the early years. Less skin in the game means less buffer when things go sideways.
Makes sense. And then finally, the creator asks viewers, share your stories in the comments if this sounds familiar, which really suggests they believe this is happening to a lot more people.
And based on these two detailed accounts and the broader trends we know about, it unfortunately seems likely that many others are facing similar shocks.
So, okay, wrapping this up, the big takeaway for you listening, it seems, is that the housing market right now, It has these hidden financial challenges. Even with a fixed rate mortgage, those escrow costs, property taxes, homeowners insurance, they can change dramatically and quickly.
Yeah, your total monthly payment is definitely not set in stone just because your interest rate is fixed. Homeowners, and especially prospective buyers, need to be really proactive about understanding and, frankly, anticipating these potential increases.
You can't just focus on the P&I, the principal and interest anymore. You have to really dig into the T&I, the taxes and insurance, and understand how those might change.
Exactly. Ask questions about historical tax increases in the area. Get multiple insurance quotes and ask about factors that could raise your rates significantly. Understand if you're in a high-risk zone for disasters.
It makes you wonder, too, about the wider market. If enough people face these sudden, unsustainable payment hikes, what does that do to overall housing stability?
It's a significant question. It impacts affordability, could increase distressed sales or foreclosures if it becomes widespread, and definitely affects homeowner confidence.
So maybe the final thought to leave everyone with is this. Given how unpredictable these costs, especially taxes and insurance, seem to be becoming, what are the really critical questions you should be asking, whether you're looking to buy or you already own a home? What questions go beyond just that initial interest rate to help you prepare for this kind of financial risk?
That's the key question, isn't it? It's about doing deeper due diligence, understanding the local tax situation, the insurance market realities, projecting those costs forward realistically, and ensuring you have a genuine financial buffer. It's not just about affording the payment today, but affording potential increases tomorrow.
Definitely something to think seriously about. A lot more complex than just getting that pre-approval letter.
Much more complex.